Welcome back. In this module, we're going to explore a concept that could transform how you think about your trading development: psychological capital. We carefully track and manage our financial capital as traders. We calculate position sizes, set stop losses, and ensure we're not risking too much on any single trade. Yet few traders apply the same rigor to managing their psychological capital, arguably their most valuable trading asset. So what exactly is psychological capital? It refers to your capacity to make rational decisions under pressure, maintain emotional equilibrium during drawdowns, adhere to trading rules despite impulses to deviate, process market information objectively, and recover from losses without destructive behaviors. Like financial capital, psychological capital can be depleted through overuse or poor management. It can be replenished through specific practices. It can be invested wisely or squandered foolishly. It can grow over time through compound effects. And it can be protected through proper risk management. I've observed that psychological capital often deteriorates before financial capital. The degradation follows a predictable pattern. Psychological capital depletes, leading to poor decisions, which then deplete financial capital. Recognizing when your psychological capital is running low is crucial for preventing financial losses. Warning signs include heightened emotional responses to normal market movements, difficulty following established trading rules, obsessive checking of positions, sleep disturbances related to trading concerns, increased justification of rule violations, and trading to alleviate uncomfortable emotions. The good news is that just like financial capital, psychological capital can be measured, managed, and grown over time. Throughout this course, we'll explore specific practices for building and preserving your psychological capital. One of the most valuable approaches is tracking your psychological capital as systematically as your financial capital. This might involve rating key psychological indicators like emotional balance, decision quality, and rule adherence at the beginning and end of each trading session. On days when your psychological resources are depleted, you might reduce position sizes or avoid trading entirely. This practice has prevented countless poor decisions for successful traders who recognize that their psychological state directly impacts their decision quality. It's also important to understand that different types of trading require different levels of psychological capital. More volatile markets, larger position sizes, and longer holding periods all tend to consume more psychological resources. By matching your trading approach to your current psychological capital level, you can prevent the destructive cycle of depletion that leads to poor decisions. Another key insight is that psychological capital doesn't replenish automatically. It requires deliberate practices and sufficient time. Many traders make the mistake of jumping right back into full trading activity after difficult periods without allowing their psychological resources to regenerate. This is similar to trying to trade with a depleted financial account. The math simply doesn't work. Throughout this course, we'll explore specific regeneration practices that help replenish psychological capital after it's been depleted. These include physical activities, mental exercises, and environmental modifications that support psychological recovery. We'll also develop practices for preserving psychological capital during challenging market periods. Just as you might implement more conservative position sizing during volatile markets to preserve financial capital, there are specific approaches for conserving psychological resources when markets become challenging. By understanding, measuring, and managing your psychological capital with the same care you apply to financial capital, you'll develop a more sustainable and effective trading approach that can withstand the inevitable challenges that markets present. In our next module, we'll explore common misconceptions about trading psychology that often prevent traders from making meaningful progress in this crucial area. See you there.